All right, let's dig into something that impacts literally every aspect of our lives. Economics.
It really does, yeah.
Beyond the headlines and stock market reports, what does it truly mean to study how we produce, distribute, and consume everything around us?
That's the core question, isn't it?
Today we're taking a deep dive into the fascinating world of economics, drawing from a comprehensive overview that shows just how broad and influential this behavioral science truly is.
It's definitely broad.
Our mission for you is to quickly grasp the core concepts, historical evolution, and key distinctions within this vital field, giving you those aha moments that make you feel truly well-informed.
Hopefully a few aha moments, yeah.
So, to start, the very definition of economics has actually evolved quite a bit over time. It wasn't always just economics, was it?
Not at all, no. The discipline was originally known as political economy.
Right.
That term's rooted in the ancient Greek oikonomia, which basically meant how to manage a household or, even a state. The modern, shorter term, economics. Well, that only really gained traction in the late 19th century. Interestingly, back in 1776, Adam Smith, in his groundbreaking work, The Wealth of Nations, he saw political economy as an inquiry into the nature and causes of the wealth of nations.
The classic definition.
Exactly. Aiming to provide revenue for both individuals and the state. Then, in 1803, Jean-Baptiste refined it a bit further.
How so?
He defined it as the science of production, distribution, and consumption of wealth, kind of distinguishing the science itself from its public policy applications.
Okay, so making it more of a distinct field to study.
Precisely.
And after all that formal definition, economics somehow picked up a rather evocative nickname, didn't it? The dismal science.
Ah, yes, the dismal science.
Where did that somewhat gloomy label come from?
Well, that famous epithet was coined by Thomas Carlyle in 1849.
Carlyle, okay.
And it's often linked, to Thomas Malthus's rather pessimistic analysis from 1798.
Malthus population, right?
Exactly. Malthus argued that human population would tend to grow geometrically, while the food supply would only increase arithmetically.
So basically, we'd run out of food.
That was the stark implication, yeah. Population would inevitably outstrip resources, leading to chronically low living standards, famine, misery.
Cheery stuff.
Not exactly a cheerful outlook, no. But even with that nickname, the definition continued to expand. Alfred Marshall, in his 1890 Principles of Economics,
A big one.
huge, he broadened the scope significantly, defining it as a study of man in the ordinary business of life.
Okay, so shifting away from just wealth.
Right, shifting the focus beyond just wealth to understanding human behavior itself in everyday life.
So if Marshall opened the door to understanding individual behavior, who really honed in on what's perhaps the most commonly cited definition today? I'm thinking of Lionel Robbins.
You're spot on. Lionel Robbins in 1932 proposed this highly influential definition that still shapes how many economists see the field.
What was his take?
He said, "Economics is the science which studies human behavior as a relationship between ends and scarce means, which have alternative uses."
Ends and scarce means.
Scarcity.
Scarcity is the absolute key. What's important here is that Robbins emphasized this as an analytical definition,
Main.
meaning economics isn't defined by what it studies, like wealth or money, but by how it studies things, through the lens of scarcity and choice.
Ah, okay. The methodology.
Exactly. He argued you could apply economic reasoning to almost any area of human activity, managing a business, even studying crime.
Crime, really?
Well, yeah, as long as it involved making choices with limited resources. This idea really resonated with economists like Gary Becker.
Becker, right. Rational choice theory.
Yep. He saw economics as a powerful approach combining maximizing behavior, stable preferences, and market equilibrium, used relentlessly and unflinchingly to understand a vast array of human decisions.
That makes a lot of sense, seeing it as a framework for understanding choices under scarcity. But I've also heard some pushback on that perhaps it broadened the scope a little too much. This raises an important question, and you're right, there is a strong critique.
Yeah.
Thinkers like Ha-Joon Chang argue that this method-based definition is, well, rather peculiar among sciences.
So.
They point out that, biology defines itself by studying living organisms, physics by studying matter and energy. They're defined by their subject matter.
Right, by what they study.
Exactly. Chang suggests that by redefining itself purely on methodology, economics risks becoming a kind of theory of everything based solely on rational choices.
And potentially missing other things.
Potentially ignoring other crucial aspects of human behavior and society. It's a really fundamental debate about the boundaries of the field itself.
That debate about definition, subject versus method, it actually seems to echo through centuries of economic thought.
It really does.
To truly grasp it, we probably need to trace where these ideas first began. So where do we even begin to unpack this rich history?
Well, we can trace some threads way back to antiquity. You've got figures like Hesiod, Aristotle.
The Greek.
Right, focusing on practical stuff like household management, even debating concepts like use value versus exchange value.
Yeah.
But the first really distinct schools of thought emerge much later.
Yep.
In the 16th to 18th centuries, we had the mercantilists.
Mercantilism.
Gold and silver.
That was their core belief, yeah. A nation's wealth was directly tied to its pile of gold and silver.
So export everything, import nothing.
Pretty much. Promote exports, heavily restrict imports, even block manufacturing in colonies, anything to keep that precious metal flowing in.
Sounds restrictive.
It was. Then, in 18th century France, we saw the rise of the physiocrats.
How are they different?
They offered a sharp contrast. They believed agriculture was the sole source of wealth.
Just farming.
Just farming.
Yeah.
They saw the economy as this circular flow of income and output, almost like a living organism. And crucially,
Yes.
they were the first big advocates for laissez-faire.
Let it be. Minimal government. Exactly. Minimal government intervention. Adam Smith, who we'll get to, actually admired their system for its emphasis on sort of natural order.
And speaking of Adam Smith, that brings us to what's often considered the true birth of economics as a separate academic discipline, classical political economy.
Precisely. Adam Smith's 1776 masterpiece, The Wealth of Nations, is widely seen as the foundational text.
Still read today.
Absolutely. He broke down a nation's wealth, identifying land, labor, and capital as the key factors of production.
The building blocks.
Right. And Smith famously showed the power of specialization through the division of labor.
The pin factory example.
That's the one. Arguing it dramatically increases productivity. But maybe his most enduring idea is the invisible hand.
The famous phrase.
Yeah. The concept that individuals, just by pursuing their own self-interest in a free market, inadvertently promote the greater public good.
As if guided.
Almost as if guided by an unseen force. It's a powerful, almost poetic image.
But not everyone was so optimistic.
No, definitely not. Not all classical thinkers shared Smith's optimism. Thomas Robert Malthus in 1798 presented that rather bleak outlook we mentioned.
Population growth again?
Population growth outstripping food production, leading to diminishing returns and poverty. Then came David Ricardo in 1817.
What was his focus?
He focused on how income was distributed among landowners, workers, and capitalists. But he's most famous for the principle of comparative advantage.
Trade theory. This is crucial.
It's bedrock. It explains why countries should specialize in producing goods where they have a lower relative production cost, even if they aren't the absolute best at anything.
So even if one country is better at making everything.
Even then, specialization leads to gains from trade, boosting overall global output. And then by 1848, you have John Stuart Mill.
Another giant.
A pivotal figure. He made this crucial distinction. While markets might be efficient at allocating resources,
Yes.
he suggested society might need to intervene to achieve a more equitable distribution of income. The market doesn't automatically guarantee fairness.
Interesting. So questioning the outcomes, not just the mechanics.
Right.
So while some focused on markets, others, like Karl Marx, offered a really powerful critique of the entire system.
Yes, Karl Marx's work, especially Das Kapital in 1867, presented a radical counter-narrative.
What was his main argument?
He developed the labor theory of value, arguing that a commodity's value comes from the labor needed to produce it.
Okay.
And from this, he derived the theory of surplus value,
Which is?
the claim that capitalists exploited labor by paying workers less than the value their work actually created, and that difference is the source of profit.
Exploitation, basically.
That was his core argument. His ideas, of course, profoundly influenced socialist and communist movements worldwide.
And then, as the 19th century drew to a close, a different wave of thought emerged that would fundamentally reshape things, ushering in what we now call neoclassical economics.
Exactly. Neoclassical economics really gained prominence between, say, 1870 and 1910. And it's this school that truly popularized the term economics itself, moving away from political economy.
What were their main contributions?
They systematically integrated supply and demand to show how they jointly determine prices and quantities in market equilibrium. big shift.
And they dropped the labor theory of value.
They did. They replaced it with the idea of marginal utility, the extra satisfaction from consuming one more unit to explain demand.
More focus on the consumer.
And on mathematical rigor. They adopted more mathematical methods, aiming for the precision seen in the natural sciences.
So more formulas, less philosophy.
A bit like that, yeah. Their focus was intensely on incentives, costs, and rational decision-making by individuals and firms. This is really the foundation of modern microeconomics.
But the economic landscape shifted dramatically again in the 20th century, especially with John Maynard Keynes. The Great Depression must have been a huge catalyst here.
Absolutely enormous. The Depression exposed huge flaws in the prevailing neoclassical thought, which really struggled to explain why unemployment stayed so high for so long.
It wasn't self-correcting, like the model suggested.
It certainly didn't seem to be. This paved the way for Keynesian economics, stemming from Keynes's revolutionary 1936 book, The General Theory of Employment, Interest, and Money.
A game changer.
Completely. This work essentially launched modern macroeconomics as a distinct field. Keynes focused on short-run dynamics, arguing economies could get stuck with high unemployment because of insufficient effective demand.
But just weren't spending enough.
Basically, yeah. And his solution was groundbreaking at the time: active government intervention.
Using policy.
Using both monetary and fiscal policy to stabilize the business cycle and pull economies out of recessions. A fundamental break from laissez-faire.
And what happened after World War II? Did Keynesian ideas just dominate?
They were dominant for a while, but not unchallenged. Post-WWII, we saw several important evolutions. In the 50s and 60s, monetarism rose up, led by Milton Friedman.
Friedman. All about the money supply.
Exactly. Monetarists argued fluctuations in the money supply were the primary cause of economic instability. They favored stable monetary policy rules over active fiscal intervention.
Was it successful?
It was very influential for a time, especially in the 70s and 80s, but its predictive power kind of waned, and it was largely abandoned as the sole framework. Then, in the 1970s, new classical economics emerged.
Led by
Figures like Robert Lucas. They introduced the concept of rational expectations.
meaning people aren't dumb.
Well, meaning people use all available information to make the best possible forecasts and decisions. This led to powerful ideas like the Lucas critique,
Which is it?
which suggested that traditional policy models could be flawed because people's expectations would adapt to policy changes, potentially undermining the policy's intended effect.
Making policy harder.
Much harder, potentially. Then, in the 1980s, you get the new Keynesian economists. Think George Akerlof, Janet Yellen.
So, adapting Keynes.
Right. They adopted rational expectations and micro-foundations from the new classicals, but they still emphasized market failures.
Like what?
Things that explain why prices and wages might be sticky, why they don't adjust instantly to economic shocks, which can lead to unemployment.
Okay, so blending idea.
Exactly. And by the 2000s, this evolution led to what's often called the new neoclassical synthesis.
Synthesis. Sounds complex.
It is. It integrates the rational expectations and optimizing frameworks from new classical theory with the new Keynesian ideas about sticky prices and market imperfections.
And what does that look like in practice?
It results in these complex models known as dynamic stochastic general equilibrium, or DSGE models.
DSGE. I've heard of those.
They're now standard tools in most central banks. Think of them as sophisticated simulations trying to model the whole economy.
Wow.
And after the 2008 financial crisis, there's been an even bigger push to integrate the financial system better into these models, draw more from behavioral economics, and focus on differences between agents.
So the field is still very much evolving.
Constantly.
That's a huge span of thought, from ancient Greece to these incredibly complex modern models. Are there any other important schools we should quickly touch on, offering different perspectives?
Oh, absolutely. Beyond the mainstream, several other influential schools offer different lenses. The Austrian school, for instance.
Hayek,
Mises, emphasizing individual action, property rights, a minimal state role, and the importance of decentralized knowledge in markets.
Okay. What else?
Then there's post-Keynesian economics, often linked with Joan Robinson. They focus more on macroeconomic rigidities, deep uncertainty, and adjustment processes, often questioning those perfect market assumptions.
Different focus.
Definitely. We also have ecological economics, which is incredibly important today.
Environment and economy.
Exactly. Studying the interplay between human economies and natural ecosystems, often emphasizing the limits of natural resources and questioning how easily we can substitute man-made capital for natural capital.
A critical perspective now.
Vitally important. And finally, feminist economics.
How did that fit in?
It plays a vital role by highlighting how gender roles and inequalities shape economic outcomes. It challenges analyses that are often gender-blind and promotes policies aimed at greater equality.
Bringing in factors often ignored.
Precisely, adding crucial dimensions to the analysis.
So, with all these complex theories, models, and schools of thought, what does this all mean for how economists actually do their work? What are their tools of the trade today?
Well, economists primarily rely on two main types of research: theoretical and empirical.
Theory and data.
Basically, theoretical research involves building analytical economic models. The goal is to create simplified maps of reality.
Models aren't reality, but useful maps.
Exactly. With clear assumptions, allowing economists to make precise predictions and generate hypotheses that can be tested. Mathematical economics, like Paul Samuelson's work, uses math to express these theories rigorously.
Okay, so building the framework.
Right. Then empirical research is all about testing those theories using real-world economic data.
How do they do that?
Often with the help of econometrics, which is essentially statistical methods applied to economic data.
Statistics for economics.
Pretty much. Since large-scale controlled experiments are often difficult or impossible in economics, you can't easily rerun the 2008 crisis with a different policy.
Right.
Researchers frequently rely on observational studies and statistical techniques like regression analysis.
Trying to find relationships in the data.
Exactly. Trying to estimate the strength and significance of hypothesized relationships, giving us a probabilistic understanding of how things connect.
That makes sense. It sounds like the field is trying to bridge that gap, though, with more controlled approaches, maybe mimicking other sciences.
Exactly, yeah. And what's truly fascinating here is the rapid growth of experimental economics.
Running actual experiments.
Yes, often in laboratory settings with real human participants, sometimes online. They use scientifically controlled experiments to directly test economic assumptions and theories.
Like psychological experiments.
Very similar in method. This significantly reduces the distinction from natural sciences and has sometimes revealed that some long-held ideas about rational behavior aren't entirely correct.
So challenging the assumptions.
Precisely. This approach is closely linked to behavioral economics.
Kahneman and Tversky. Biases.
Exactly. Psychologists like Daniel Kahneman, who won a Nobel Prize in 2002, made groundbreaking discoveries about the cognitive biases and heuristics that affect our decisions, often making us act, well, irrationally.
So economics meets psychology.
And even neuroscience. Techniques from neuroeconomics using brain imaging are also part of this cutting edge. Together, these methods really reinforce the idea that economics is striving to be a genuine science, grounded in observation and experimentation.
Okay, let's shift gears and dive into the two big branches most people hear about, micro and macro. How do they differ, and what kinds of questions does each tackle?
Okay, so if we connect this to the bigger picture, microeconomics is essentially the zoomed-in view.
Bottom up.
Sort of, yeah. It examines the basic elements within economies. Individual agents like households, firms, buyers, sellers. It studies how they interact within specific markets and what outcomes emerge.
Like studying the market for coffee or cars.
Exactly. Microeconomists analyze different market structures. You've got perfect competition where everyone's a price taker with no power.
Lots of small farms, maybe.
Right. And then imperfect competition, like monopolies or oligopolies, where firms can influence prices. They're price makers?
Big tech firms, perhaps.
Could be. Micro also distinguishes between partial equilibrium, looking at just one market in isolation, and general equilibrium, which tries to model how all markets interact simultaneously. Much harder.
So what are some of the core concepts microeconomics really digs into?
Well, a central concept is production, how we turn inputs like labor, capital, land into outputs like goods and services.
Making stuff.
Right. And a big focus is economic efficiency, often measured by Pareto efficiency.
Pareto, what's that?
It's a state where you've squeezed out all possible gains. You literally cannot make anyone better off without making someone else worse off.
No more win-wins possible.
Exactly, and no more free lunches left. A powerful visual tool here is the Production Possibility Frontier, or PPF.
The curve graph.
That's the one. Imagine a graph showing the maximum amount of two goods an economy can produce with its resources. It clearly shows scarcity. You can't be outside the curve.
Limited resources.
And opportunity cost, the curve slopes downwards, showing the trade-off. To get more of one good, you must give up some of the other.
The cost of choosing.
Precisely. Points on the curve are productively efficient. Points inside mean you're wasting resources.
Got it.
And as we touched on with Ricardo, specialization is crucial for efficiency.
Doing what you're best at, relatively speaking.
Right, specializing where you have a comparative advantage. This leads to those profound gains from trade, boosting total output and well-being. It's why countries trade so much.
Even similar countries trading similar things.
Yep. Often due to economies of scale, getting more efficient as you produce more. And at the heart of micro, you have supply and demand.
The absolute basics.
A fundamental organizing principle for prices and quantities. The law of demand. Price up, quantity demanded down.
Makes sense.
And the law of supply. Price up, quantity supplied up, usually because it's more profitable.
Okay.
Where the supply and demand curves cross, you get market equilibrium, the price and quantity where the market clears.
Where buyers and sellers agree, basically.
In a sense, yes. Micro also looks closely at firms, how they combine labor and capital, achieve economies of scale. Ronald Coase had a famous theory.
About why firms exist.
Yeah. He theorized they exist to reduce transaction costs compared to just trading everything in the open market. It's cheaper to organize some things internally.
Interesting.
And related fields like industrial organization look at strategic firm behavior, while managerial economics applies micro tools to help businesses make better decisions.
And how does uncertainty factor into all this? Decisions aren't made with perfect knowledge.
Oh, uncertainty's huge. It affects everything from savings to investment to financial markets. One powerful tool for analyzing strategic interactions under uncertainty is game theory.
Like poker strategy.
Sort of, but much broader. Developed by von Neumann and Morgenstern, it models situations where one agent's actions affect others. Think firms competing, countries negotiating.
Even outside economics.
Absolutely.
Yeah.
Used in politics, biology, everywhere. And tied to uncertainty is information asymmetry.
Unequal information.
Exactly. George Akerlof's Market for Lemons paper is the classic example.
Used cars.
Yep. If buyers can't tell good used cars from bad ones, lemons, they'll only offer an average price. This drives good cars out of the market because sellers won't accept the low price.
So bad information kills the market.
It can severely damage it. This leads to related problems like adverse selection, like only high-risk people buying insurance because they know they need it.
Driving up premiums for everyone.
Right. And moral hazard, where having insurance might make you behave more riskily because you're covered.
Like driving less carefully if you have full insurance.
Potentially, yeah.
Yeah.
These issues, information problems, natural monopolies, public goods, externalities like pollution.
Where costs spill over onto others.
Right, costs or benefits affecting third parties. All these contribute to what economists call market failure.
When the market doesn't lead to an efficient outcome.
Exactly. Situations where the standard assumptions break down. And this is often the justification for government intervention taxes, subsidies, regulations to try and correct these failures.
Okay, that's micro. Now let's zoom out to the big picture, the top-down view. Macroeconomics. How does it tackle the economy as a whole?
Right. Macroeconomics looks at the economy broadly, the aggregate picture. It explains things like total national income, overall output, GDP, the unemployment rate, inflation.
The stuff you see in the news headlines.
Often, yes. It also analyzes the effects of government policies, monetary policy from the central bank, fiscal policy from the government on these big aggregates.
And it connects to micro now.
Increasingly, yes. Modern macro tries to build its models on micro foundations, recognizing that aggregate outcomes result from millions of individual decisions.
So what are the big topics in macro?
Well, a key area is economic growth. Understanding the factors that drive increases in output per person over the long run.
Like investment, technology.
Investment, population growth, technological change, education, institutions. All crucial for explaining why some countries get rich and others stay poor.
The billion-dollar question.
It really is. Another central focus is the business cycle.
Booms and busts.
Exactly. The ups and downs in economic activity. And what's truly remarkable here is how the trauma of the Great Depression really spurred Keynes.
Back to Keynes.
His work explaining why economies might suffer from persistent high unemployment, why they might not self-correct quickly, and his advocacy for active policy responses were revolutionary for macro.
Leading to those models we discussed.
Yes, things like the early ISLM model, Later, the new classical ideas about rational expectations and the new Keynesian focus on sticky prices and wages, all trying to understand and manage these cycles.
What about unemployment itself?
Macro analyzes different types of unemployment. There's frictional, just the time it takes to switch jobs.
Normal turnover.
Right. Structural, a mismatch between worker skills and available jobs, maybe due to big economic shifts like deindustrialization.
Harder to fix.
Much harder. And cyclical unemployment, the kind that rises during recessions and falls during booms, linked directly to the business cycle.
And there's a link to output.
Yeah, Okun's law describes an empirical relationship. Roughly, for output to grow about 3% above its trend, unemployment tends to fall by about 1%. It's a rule of thumb.
Interesting. And money. Macro must deal with money.
Oh, absolutely. Money is fundamental. As Francis Amasa Walker said, money is what money does.
Meaning.
It serves as a means of final payment, a unit of account, a store of value, and crucially, a medium of exchange. It makes trade vastly easier by reducing transaction costs.
We couldn't function without it.
Not in a complex economy. And monetary policy, conducted by central banks.
Like the Fed or the Bank of England.
Exactly. Primarily involves adjusting interest rates to influence borrowing costs, which affects investment, consumption, aggregate demand, and ultimately wages and inflation.
Trying to keep inflation low and stable.
That's the main goal in most developed countries now, inflation targeting.
And the other policy tool, fiscal policy.
Right, fiscal policy. That's the government adjusting its spending levels and tax rates.
Spend more or tax less to boost the economy.
That's the basic idea, yeah. Increase spending or cut taxes to boost aggregate demand, especially if there's an output gap, the economy's running below potential. This works through multiplier effects.
The initial spending creates more spending.
Exactly. But there are limitations, things like crowding out government borrowing, potentially raising interest rates, and reducing private investment.
So government spending replaces private spending.
It can, to some extent. And there's also Ricardian equivalence, the idea that people might just save tax cuts if they expect taxes to rise later to pay off the debt.
So fiscal policy isn't always straightforward.
Definitely not. There are debates about its effectiveness and timing. And finally, a huge topic in macro today is economic inequality.
Income gaps, wealth gaps.
Yes, measured by income, wealth, consumption. Tools like the Gini coefficient help quantify it.
And why does it matter for macroeconomics?
Well, research increasingly links high levels of inequality to things like political and social instability, and there's evidence it can even hinder overall economic growth in the long run.
So it's not just a fairness issue, it's an economic one too.
Absolutely. And it's clear that government tax and spending policies, especially social spending on health, education, and transfers, significantly reduce income inequality in most developed countries.
So with such a vast and evolving field, covering everything from individual choices to global inequality, what does it take to be an economist today? What kinds of work do they actually do?
Well, the professionalization of economics has really accelerated, especially with the growth of graduate programs since around 1900. It's shaped the field profoundly.
So more specialized training.
Definitely. Economists now work across incredibly diverse sectors, academia, of course, doing research and teaching, but also as consultants in private industry.
Like banking and finance.
Banking, finance, tech companies are hiring more economists now, too. And, of course, extensively in government.
Where government?
National treasuries, finance ministries, central banks, international organizations like the IMF and World Bank, various regulatory bodies. They're everywhere, really.
And what skills do they need? Lots of math.
A lot of math and statistics, yeah. They heavily rely on sophisticated tools. Calculus, linear algebra, statistics, econometrics, game theory, and increasingly computer science for handling big data and complex modeling.
So it's quite quantitative.
Very quantitative these days, for the most part.
And as the field professionalizes, is it also becoming more diverse in terms of who becomes an economist?
Yes, and that's a really important trend. Yeah, and what's kind of fascinating here is the growing presence and recognition of women in economics.
Historically, it was very male-dominated.
Extremely. Though figures like Harriet Martineau and Mary Paley Marshall made important contributions early on, they were often overlooked.
But that's changing.
It is changing, albeit perhaps slowly. More recently, we've seen women like Elinor Ostrom, Esther Duflo, and Claudia Goldin receive the Nobel Memorial Prize in Economic Sciences.
That's huge recognition.
Absolutely. And others like Susan Fay, Amy Finkelstein, Emmy Nakamura, Melissa Dell receiving the John Bates Clark Medal, which goes to the top American economist under 40.
So progress at the top levels.
Definitely. Although women do remain globally underrepresented overall. One study found about 19% of authors in a major economics paper database in 2018 were women.
Still a way to go.
Still a way to go, but their authorship share in top journals has been on a consistent rise since the 1970s. So the field is gradually expanding its perspectives.
Wow. Okay, so we've covered a lot of ground. From managing a household in ancient Greece to modeling global financial instability and the nuances of human bias, economics truly lives up to its deep dive potential.
It certainly does.
We've journeyed through its evolving definitions, explored pivotal thinkers from Smith to Keynes to Friedman and beyond, delved into the rigorous tools economists use, and unpacked the vast realms of micro and macroeconomics, right down to who practices it.
Indeed. And what's truly remarkable, I think, is how this field, initially concerned with just wealth, then focused on scarcity, has expanded its reach through increasingly rigorous analysis to touch on almost every aspect of human behavior and social interaction.
It really has become a science of choice in many ways.
In many ways, yes. It's a testament to the power of thinking systematically about choices, incentives, and resources. This raises an important question, though. If economics is fundamentally the science of human behavior in the face of scarcity,
Yeah.
how will its models and insights continue to evolve as we face these massive new global challenges? Things like accelerating climate change, rapid technological disruption like AI.
Big, complex problems.
Huge problems.
Yeah.
All while trying to balance individual choices and freedoms with our collective well-being. How does economics adapt to that?
That's a deep question for the future of the field. And maybe something for you, our listener, to mull over. As you navigate your own daily choices, big or small, from what to buy for dinner to career decisions to how you spend your time or money, how often are you implicitly applying economic principles, thinking about trade-offs, costs, benefits, even without realizing it?